Unit 1, Topic 3, Video 2. Hello students. In previous video we discussed about accounting concepts. There are certain conventions to use these concepts. So today we will discuss about accounting conventions. Let's start with its meaning. Accounting conventions refer to the common practices which are universally followed in recording and presenting accounting information for the business entity. Accounting conventions are evolved through the regular and consistent practice over the years to facilitate uniform recording in the books of account. Let's have a look at the list of accounting conventions. First one is full disclosure. Secondly, consistency. Third one, conservatism. Fourth one, materiality. And lastly, objectivity. Let's start with the description. First one is full disclosure. Full disclosure means that there should be full, adequate, and fair disclosure of information. Full means complete and detailed presentation of information. Adequate means sufficient set of information. And fair means equitable treatment to all users. Companies Act of different countries make some provisions for preparation of accounts. The purpose of these provisions is to disclose all essential information so that the view of financial statements should be true and fair. However, the term disclosure does not mean all information. It means disclosure of information that is significant to the users of these financial statements, such as investors, owners, and creditors. Second one is consistency. To compare the results of different years, it is necessary that accounting rules, principles, conventions, and accounting concepts for similar transactions are followed consistently and continuously. Reliability of financial statements may be lost if frequent changes are observed in accounting treatment. According to this concept, there should be uniformity in accounting processes and policies from one period to another. Changes are permitted in some exceptional cases when the new method is considered better and can reflect the true and fair view of the financial position of the company. For example, if a firm chooses cost or market price, whichever is lower method for stock valuation, and written down value method for depreciation on fixed assets, it should be followed consistently and continuously. Consistency also states that if a change becomes necessary, the change and its effect on profit or loss and on the financial position of the company should be clearly mentioned. Next is conservatism. Anticipate no profits but provide for all losses. It is based on the policy of playing safe in regard to showing profit. As per this convention, profit should not be overstated because, if so happens, it may lead to distribution of dividend out of capital. For future events, profits are not anticipated, but provisions for losses are provided as a policy of conservatism. Under this policy, provisions are made for doubtful debts as well as contingent liability, but we do not consider any anticipatory gain. Second last is materiality. According to this convention, the financial statements must disclose all material, relevant, and reliable information which can be beneficial to interested users for decision making. If the disclosure or non disclosure of an information might influence the decision of the users of financial statements, then that information should be disclosed. And the last convention is objectivity. Objectivity connotes reliability and trustworthiness. Every transaction must be supported by the documentary evidence and should be free from personal bias. Some documentary evidences for recording transactions are invoices, bills, cash memos, etc. Thank you.